welcome back to Investing Talk Podcast.
Today we're looking at NIO. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For you, the listener, what we've gathered really paints this classic picture, doesn't it? Strong performance on one hand.
Yeah, operationally strong.
Exactly. But then you've got these persistent, long-term financial risks hanging over it.
Right, like the dilution we saw and just the general worry about when they'll actually turn a profit.
Precisely. But look, there's also real renewed momentum right now. We're seeing several key catalysts lining up, pushing out into 2026.
Okay, so our job here is to sort of unpack that tension, right? The good versus the risky.
That's it. We need to see if this current bullish trend can actually last.
Let's start with that momentum then, because it's pretty hard to ignore when you look at the delivery numbers.
It really is. Even when the overall Chinese EV market was looking a bit shaky earlier this year, NIO showed, serious strength.
Yeah, the figures just kept climbing. And September, wow, 34,749 deliveries. That's stunning.
It signals that their product mix, their portfolio, is finally hitting that consumer sweet spot people are buying.
And that volume, that's the engine driving the whole bullish argument, isn't it? It's why everyone's kind of holding their breath for the next report.
Absolutely. Analysts are thinking, okay, even with the Golden Week holidays slowing things down a bit in early October.
Which is normal, yeah.
Right, totally normal. But they think NIO might still post an all-time monthly record for the full month.
And if they hit that record?
Well, it just proves the ramp-up is real, that their expanded manufacturing is actually delivering.
And it's not just how many cars. It's which cars people are excited about, that Onvo sub-brand.
Oh, yeah, the L90 model pre-launch buzz, that definitely moved the needle on the share price.
People see Onvo as NIO sort of smartly moving into the mass market.
Without cheapening the main NIO brand. It's a tricky balance.
Exactly. And Wall Street definitely took notice of all this execution.
You bet. The stock recovered, nearly 64% year-to-date from those April lows? Pretty dramatic.
And then Goldman Sachs steps in, October, raises the price target by 62% to $7. That's a big signal.
A very big signal. And they specifically pointed to the models, the L90, the updated ES8, saying they're just more competitive now.
Okay, but here's the catch, right? The nuanced listeners need to grab from the sources. Goldman raised the target.
Dramatically raised it, yes.
But kept the overall rating at neutral. So why? If things are going so well, why not upgrade the stock?
It boils down to one thing. Valuation skepticism.
So they like the doing, but not the price.
Pretty much. They see the improvements, the products are good, volumes are up, definitely. But they're still hesitant about the valuation multiples right now.
So they're basically saying, great job, NIO, but the current stock price already reflects that success.
Exactly. You've captured the current analyst view perfectly. There's faith in the execution, but skepticism on the valuation. It puts the pressure on future performance.
Which takes us straight into the financials, because to justify that price, let alone push it higher, they need to hit some, frankly, staggering targets.
Oh, they're incredibly aggressive. Management is aiming to double vehicle deliveries in 2025 compared to 2023.
Double. From roughly 165,000 to
around 330,000 units in just 2 years. That's huge.
That kind of scale-up would be massive for margins, potentially.
If they can manage it efficiently, yes. And consensus forecasts seem to back this ambition, projecting revenue growth at about a 28% CAGR through 2027.
Okay, but doubling volume, launching new brands like Onvo, that costs a fortune, right? R&D, CapEx.
An insane amount of capital, yes. Which brings up the liquidity question. Are they okay for cash?
What do the sources say? How's the balance sheet looking?
Well, as of June 30th this year, they had RMB 22.5 billion. That's about, $3.1 billion US dollars in cash and equivalents?
Okay, so over $3 billion. That's a decent cushion.
It is. It gives them breathing room for the R&D, especially on those next-gen batteries. And scaling up production, it's a buffer.
But even $3 billion, the Chinese EV market is a battlefield, super competitive.
It really is.
So what's NIO's actual competitive advantage? What's their moat that justifies all this spending?
It's actually quite fascinating. They've kind of redefined premium a bit. The moat is really built around their battery as a service, the BASIS system.
And the battery swapping tech.
And the battery swap tech, exactly. It does two key things. First, it makes the upfront cost of the car lower. more accessible premium.
Which broadens the market.
Right. And second, it creates this sticky, recurring revenue stream. Customers get used to the convenience, locked into the ecosystem. That's hard for others to copy quickly.
Plus, they're not just relying on services, they're pushing the core tech too, like that 150 kilowatt-hour solid-state battery they're working on.
Exactly. Investing in the future tech to try and stay ahead. It shows long-term thinking.
And they're looking beyond China too, right? That Dubai hub opening.
Yeah, the push into the MENA region, Middle East and North Africa, it signals they're looking for new growth areas, maybe less crowded than home.
Okay, now we absolutely have to flip the coin. Let's talk risks. Because all this growth, all this R&D, it has a cost. And shareholders felt it back in September.
Oh, yes. That was the big speed bump, the $1 billion equity offering.
Caused a 9% drop temporarily. Huge dilution concerns.
Yep, and this is where you really have to analyze management's thinking.
Right. They had over $3 billion in cash. Why raise another $1 billion through equity then? Why dilute shareholders right when things seem to be picking up?
That's the absolute core risk flashing right there. When they choose dilution, even with the decent cash pile, it suggests the burn rate.
How much cash they're spending.
Exactly. The cash needed for R&D, the global expansion, getting ONVO off the ground, it's just higher than maybe that $3.1 billion could comfortably cover long term, especially aiming for 330,000 cars.
So they chose growth, like extreme growth, over protecting the share count in the short term.
That seems to be the calculation, which leads to the number one question for any growth stock.
When do they actually make money?
Bingo! When does all this spending turn into actual profit? We have seen some encouraging signs recently, though.
On margins.
Yeah, gross margin. It stabilized at 8.8% in Q2 2025. That's a huge improvement from, only 1.0% back in Q4 2023?
That's a massive jump. So they're getting better at controlling costs and benefiting from the higher volume.
It looks like it. Economies of scale starting to kick in, better cost management.
Okay, but controlling cost isn't profit. Gross margin isn't net income.
Precisely. And if you zoom out to the bigger picture, the actual profitability timeline, it's still quite a ways off. Management is targeting EBIT break-even in 2028.
2028. And just remind us, EBIT.
Earnings before interest and taxes. Basically, making money from selling cars before you account for debt costs and taxes.
So the core operation breaking even 3 years from now. That feels like a long time in the EV world.
It is. It's a risky timeline. Technology changes so fast, models get old quickly.
So the main business needs 3 more years just to stop losing money operationally. But there's a slightly nearer goal, isn't there? Free cash flow.
Correct. They expect positive free cash flow, or FCF, in 2026.
And FCF is the cash left over after all the big investments, the signal they're becoming self-funding.
That's the one. Hitting positive FCF in 2026 is absolutely critical, especially when you remember they burned through negative 6.8 billion RMB just last year in 2024.
Wow. So they need a massive swing from negative 6.8 billion to positive something in just 2 years.
A dramatic turnaround is required. That 2026 FCF target is key for investor confidence.
Okay, let's look at the technicals for a sec. Where does the chart say the resistance is? Stock's been riding high, near $7 lately.
Yeah, that delivery momentum definitely gave it a lift. Sources show immediate technical resistance looks to be around that $7.85 to $8 zone.
So a ceiling nearby, potentially. But is the underlying trend still positive?
Technically, yes. What's encouraging is the alignment of the moving averages. The 50-day SMA is around $6.82. The 200-day is way down at $4.80. Both are below the current price.
Which means
it confirms a bullish trend, technically speaking. The stock seems to have broken out of that longer-term downtrend. The momentum is real, according to the chart.
that technical momentum seems to be bumping right up against that analyst wall we talked about earlier.
It really does. The median analyst price target for the next 12 months is super tight, like $6.63 to $7.50.
Which is basically where it's trading now.
Exactly. So for you, the investor, that signals the market consensus thinks all the current good news, the delivery surge, the ONVO buzz, it's mostly priced in already.
Meaning they need more good news. More catalysts to break higher.
They need perfect execution on the next set of catalysts just to justify this price, let alone push significantly past that $7, $8 resistance.
Okay, so let's talk catalysts. What are the key triggers coming up soon that could give it that necessary push?
Well, the immediate focus is financial reporting. The October delivery report is due very soon, November 2nd.
That'll be closely watched.
Very. But the main event is the Q3 2025 earnings release on November 19th. That's huge.
Why is it so critical?
It needs to validate that recent delivery strength wasn't just a blip. And crucially, we need updated guidance on that path towards the 2026 FCF target. Again, they still make it.
Got it. And beyond financials, product launches.
Yep, product news always creates volatility. Initial deliveries of the EC7 SUV and the big ET9 sedan are slated for late Q4, so November-December timeframe.
New models always bring headlines, good or bad.
Right. And don't forget the more passive stuff like potential adjustments during the December ETF, rebalancing MSCI, FTSE indices. If NIO's metrics look good, that could drive some buying.
Okay, now the juicy part, the rumors, the speculation, stuff that could really change the game if it happens.
This is where it gets really interesting, but also, highly speculative. Need to stress that.
Absolutely. Pure market chatter for now.
Yeah.
What's out there?
Two big ones that keep popping up. Number one, persistent whispers about a potential joint venture, or maybe a big strategic investment.
From who?
From a major Western automaker. Someone looking for a fast track into the Chinese EV market, partnering with a known player like NIO. That would be massive validation.
Huge. Okay, what's number two?
Market chatter suggesting the North American market entry, maybe planned for later, could be getting pulled forward, maybe as soon as Q1 2026.
Wow. A major JV or a faster U.S. launch? Either of those would completely change the narrative, wouldn't they? Especially the capital side.
Instantly. A big strategic investment could ease that cash burn worry significantly, reduce the need for more dilution. It would likely trigger a sharp re-rating of the stock, way beyond current analyst targets.
Okay, so wrapping this up for the listener, it's a complex picture. You've got strong momentum, cool products, that unique BAS moat, and a decent cash buffer for now. But that dilution was a warning sign about long-term cash needs and profitability. Real EBIT break-even is still years away, targeted for 2028.
So if you're buying now, you're essentially trading maybe 3 years of financial uncertainty for that shot at extreme growth. It's a bet on execution and patience.
The classic growth stock dilemma.
It really is. And here's the final thought for you to mull over. Even if NIO hits that super aggressive target, doubling deliveries in 2025.
Which is a huge if.
A huge if. But if they do it, the next question is critical. How much do margins have to improve in 2026 to actually hit that positive free cash flow target? And what kind of tough pricing decisions might that force them into, especially as competition just keeps getting tougher? That's the financial tightrope they have to walk.